because if you're in a hurry to develop a bottom edge, you're in very early. It means you're taking gambles. If you're very early in taking gambles, then of course you're going to start making mistakes. You're going to start getting squeezed, getting basically flushed out of trades that you shouldn't never have been in the first place. But when you see a bottom edge forming, for example, you can see in oil, we'd hit at this 94, and obviously what's happened is we got a fresh air buy opportunity, but it wasn't just one, it was two, then it was three. Three fresh air buy opportunities to buy oil off the 94. The sweep was perfect, and obviously you can always rejoin a trade at higher prices. You can always rejoin at higher prices. In other words, if it's the first time the price has ever traded into an area, by all means take profits, but try not to establish a brand new position at exactly that point, because it'll probably get tested. Yes, you might not get the best price possible, but you'll get a far safer price. You'll always be able to get an opportunity. Always be able to get an opportunity. So obviously in that case, you can see we've had a very nice rally back off this price and a very nice takeaway. The VEX trade was the dealer's level, which we tweeted out for everybody. And the dealer's level was obviously brutal. I mean, it really was a brutal trade. And you can see obviously that the dealer's level comes out from the rebalancing of inventory from the Brent session. It's not actually a WTI trade, it's a Brent oil trade. But you get the same basic idea. It gets rebalanced in here with some commercial wholesale. And with that trade narrative, we can obviously watch for the expansion. At first, it expanded north. But bearing in mind, I'm really wanting to be short. I did take a couple of pops at some longs there. I actually tweeted a message where we got a brilliant transition on the last buy trade. It was worth 20 ticks. It was worth $1,000 on a 5-lot, so it's still a pretty good trade. But when it breaks south, obviously, it was just gone, wasn't it? It was absolutely gone. The target price was glorious. We'd already established that target price, remember, from this imbalance pending buyers level that we drew on the charts. And obviously, you can see that the test into that area with the fresh air bottom edge was fantastic right there. As you come into the NYMEX Open, of course, you do another volatility expansion, basically. And as you come into the NYMEX on a 5-minute chart, you can see the high of the session is here, the low, the close was here, and therefore, at the moment, the volatility expansion on NYMEX is sell side at the moment, isn't it? Sell side. Now, obviously, it's up to you to then analyze whether you like the idea that it's sell side or not. If you don't like the idea of being short, okay, don't take the short. Look for the downticks, look for the springs, and then say, right, I'm going to try and buy into those springs. But as a straightforward volatility expansion trade, it is a short trade, just the same way as the volatility expansion here was a long trade and then a short trade. The long trade made a +1, and then the short trade obviously made an annihilation job of the sell side business here. So the VEX oil trade is at the open. The VEX oil trade is at the previous day close, and the VEX oil trade is at the Brent market open as well. Usually we start looking at the 8 o'clock candle. Why? Because it's usually a game candle, and therefore if we had a VEX trade here, it would be that candle there, which turned out to be exactly the same pretty much as the dealer's inventory level this morning. So it was buy side above from the oil open. It was a 96.80 buy. It traded a high price of 97.60. So we get lots of VEX trades. We get lots of individual VEX trades that we can obviously lean against anytime we want to. If we want to try and trade just the VEX ideas, the trades you would have had so far this morning was one buy here, a test buy here, another buy here. They all made +1s. And then a sell trade here, which made way more than +1s. And you'd be currently in a VEX sell trade at 94, probably 94.85. It's just traded a low price of 94.57. It's nearly $300 lower on the spike out of the actual cash open there. And you'd obviously be short, and you've already done a +1 in that trade anyway. So you can't really lose any money. Even if it goes right through to the top edge here, you can still break even worst case on that short trade. Mark, there's always going to be a VEX trade. I mean, the idea of VEX is very, very simple. It's any price that we can see, for example, massive volume. Any price we see massive volume, any price we see massive volume is usually tied into a key time of the day as well. So, for example, if I said to you, where was the VEX trade after the dealer's inventory, you could have said to yourself, okay, well, I've got two massive volume candles here. So based on the fact of the close and the close, you could have done a VEX trade right there, couldn't you? Could you have done a VEX trade based on that area there? Because of these two massive volumes side by side, where obviously if that becomes an accumulation, you're going to buy the break above it. If it's not an accumulation, that's really aggressive selling, right? If it's really aggressive selling, would it make sense to sell away from that price? Sure. So you would then be able to see the fact that it never went above that area. It sold off of that volume, and then it sold off of the volume again twice here. And you got a very nice ride to the downside in terms of a reward. You managed to get a brilliant trade out of that narrative as well, didn't you? Huge profits. I mean, if you look at that from a percentage point of view, and you put your stop just at the top, you'd have seen that sell-off there was actually worth 4.6 times your money. 2% risk, you just did 9% return. And that's a pretty good return for that trade, notwithstanding the fact that you were already in this one here from the short dealer inventory trade, which obviously you can see went on to make 12 times your money, 2% risk on that. You made 24% return on your account. So if you've got a $5,000 account, you did well over $1,000 on that sell based on a percentage basis, risking 2%. So any volume can be a VEX trade. The good thing about volume is that we know roughly when the volume is going to hit. We know the volume will hit, most of the time we know the volume will hit at 8 o'clock, 7 o'clock, on the top of the hour, at 2 o'clock US time when the NYMEX market kicks into live. We know it's going to kick in again. If you look in the background of the day, you'll see exactly when it kicks in. And there it is right there. There's your volume. 9:30 settlement. So 9:30 settlement is your usual RGL trade, right? So that's your settlement candle right there. And you can see it was a big top edge down to settlement. So you could have probably have done an RGL 97 to 97.30, sell side 97, 97.30. Now, what would that have meant? It would have meant you did a pretty good job to the downside. You ran stops to the top side. You made 1 hour, stopped out at break even, and then it sold off the bottom edge. And simply from that point onwards, you just made an absolute fortune. But do you see what happened to the last VEX trade there, Mark? Do you see it? Sell side 94.81, no other value lines, just the VEX trade, $94.80 right there, and you've just traded $94, $800 profit on that sell-off right there. $800 on that sell-off, guys. Is that a VEX trade or what? Is that a good VEX trade? Well, it's not $800, is it? Because I never quite traded the bottom edge just yet, but it's a $600 winner on the VEX trade, right off the cash market open. A great sell opportunity, a great VEX trade, very, very nice volatility extension from that price. And obviously that's in line with my overall macro view of oil, which was suggesting we should be trading down into the 94s anyway, down into the 93s in fact. And that's a nice trade. Could we show how we got the valuation? Absolutely. So the first thing you need to do is make sure you've got a long enough duration so you can see backwards for a reasonable amount of time. So what does this do for us? A couple of things, Patrick. The first thing it does for us is it gives us some references to look at in terms of key wholesale price levels and bullish and bearish order blocks, the commercial buying and the commercial selling. You'll be able to see things like this, rejection, for example, here. You'll see the acceptance, for example, over here at 29th, right? So you can start to recognize that this lowest price here was very aggressively rejected. So you're going to know a lot about that price when it hits, right? You're going to know a lot about that price because there's going to be a lot of trade action around there. So that's the first thing about getting into these bigger time frames. You start seeing things that you haven't seen on your 1 minute charts or your tick charts or your 5 minute charts. Secondly, you can now look at macro value. The two macro values I like to look at, well, there's three real macro values I like to look at. I like to look at the dollar valuation on oil. So we'll do that just now. So we look at the dollar valuation. We don't really get much of a valuation on this. At the time of the top edge sale, the dollar was still relatively neutral. It wasn't bullish and it wasn't bearish, but certainly when oil prices are that high, the dollar's not the main reason for the oil price being at those levels. So I was quite keen on the short trade, but that wasn't the main reason. The main reason's been the crack spread. Take a look at the crack spread for us. What do you think of that crack spread, guys? It's getting murdered, isn't it? It's getting absolutely murdered just now. So obviously the crack spread is the refiner's margin. It's how much profit the refiner's making on oil, and if the margin is getting squeezed lower, the refiners will simply demand cuts in oil prices for the refiner's margin to go back up again. We want to make sure we check that against percentages as well. That's why we did the percentage for you guys a while ago. Check the percentages to make sure the percentage is also in agreement. In other words, the margin that the refiners are getting is actually getting significantly squeezed here at these levels of price. So that means that there's going to be certainly a big demand from the refiners that oil prices should start coming down. And that's why I'm paying very, very close attention to any time the price goes above these key levels. The second main reason, of course, is simply our supply line. So for me, the supply line is oil 1 out to oil March at the moment. I'm doing 1 out to March, which gives me 6 months of supply and demand information. So if you're using something different, it'll probably be pretty much the same. But take a look at the supply line. As I zoom out this chart, take a look at the supply line and tell me if it's bullish or bearish. Well, on a macro scale, at higher prices, it's bearish. On a micro scale, it's bullish. So in other words, we can start thinking about how bullish or bearish the oil price is. But what we can do is when we came into that sell trade this morning at $97.30, the purple line is right there, right? So the purple line is where it is. All we do at that stage is we simply project that purple line along to the right-hand side, sorry, along to the left-hand side, until we intersect something, until we come across the purple line again. When we come across the purple line, we take a view of what's going on in that purple line area, and we try and find a balance. Not just a single price, but a kind of balance area where the highs and the lows meet mid-priced area. And if I look at this little balance area here from the 2nd of August, I can see we've got a peak high, we've got a peak low, and the kind of middle price area here suggests, and always err on the side of caution, guys. Always err on the side of caution when you come to these ones. So in other words, don't give yourself the best possible target. Give yourself the worst possible target from these areas. And realistically, that would suggest that we should be trading around about $93.70 to about 94, I would imagine would be realistic. So based on the valuation this morning, I thought oil should be $93.70 to $94 approximately. $94 approximately. So when we see that as an idea, well, that's a lot lower price. That's a lot lower price, Rich. What I'm saying is, if you're selling this, you want a conservative estimate. You don't want a massive target price, right? So we want to try and work out what the most conservative estimate is for this oil price. And it looks about $93.70 to 94. It does extend by another $2 beyond that. That's why in the tweets we said it can be anything from $4,000 to $6,000, right? So when we looked at the macros between $4,000 and $6,000 lower, it's an area. It's not a specific price. It's an area. So based on that area, we're starting to look at that and we're saying, okay, well, realistically, that area is this balance area here. So I think it's probably going to be about $94 to maybe approximately somewhere around about $91 and maybe $90 at a stretch. So we want to always underestimate where it could go to, and then we'll be delighted if it goes even further. Because obviously what's going to happen if the price trades down to this area is what's going to happen. the value line's going to drop anyway, isn't it? The value line's not going to go up. The value line's going to go down, and we'll be extending further still, and we'll be making new targets. Remember, it's not a static target. It's a moving target, right? If the price drops, it's highly likely that the purple line drops. It's as simple as that. Highly likely the purple line drops. So we've got a target price around about the 94s. $93.70 is what we talked about this morning. $93.70. We weren't a million miles away from that. In fact, we're just about to trade $93.70. And the reason why we should be trading $93.70 is because that value line has actually dropped. If you look at the purple line dropping down, it suggests the balance area in here is a reasonable target on a short-term basis. Agreed? The purple line suggests that the balance area here, where we got this price before, the balance area, so that suggests maybe a price of about the $93.70, makes a bit of sense. And we've just traded $93.70. So that's a good trade, a very, very nice volatility expansion as well. $94.80, $93.80. It's just done $1,000, guys, in that volatility expansion that we just talked about right there. It's just done $1,000. Pretty good volatility expansion trade, isn't it? Pretty good one. Pretty good one to get under your book. Beautiful. Looking at it from a crack spread skew as we drill down into the area, not an awful lot to get excited about, is there? There's not something looking at it and you're going, oh wow, it's got to be, it's got to be. It's not really got to be anything, is it? There's not very much in it to win it at that stage. Looks good. Very good trade, well done. Anybody that's on board, I like it. Another volatility expansion, another RGL for $1,000, guys. Another volatility, another expansion for $1,000. Love it, love it. Bonds,